Hi, and happy summer. Welcome to our update. Christian, thank you for joining me once again and for putting our chart and slide package together that we'll spend the next 15 or 20 minutes to go over with everybody.
Glad to be back. Thanks for having me, Darren.
All right, so why don't we dive right in? We had a very interesting couple days in the market, but I think before we talk about our little flash crash that we had on Monday, why don't we put a little bit of context to what we've been seeing since our last conversation together, Christian?
Fantastic. So first, a word from our lawyers, and now delving into our market review. So these charts are updated as of July 31st, just to give you a little bit more context, given we've seen some volatility in the markets in recent weeks, and that's something we'll discuss in greater detail a little later on in our presentation. But broadly, what we've seen is actually some areas of the market that weren't working over the last year have begun to start to work. And so we've seen that broadening out that we've talked about, that we've been waiting to see. It's finally come to fruition. Financials, real estate, utilities all have performed well over the last 3 months, and that's partly driven by positive expectations for rate cuts rather than further rate advances in the U.S., and we're also going to get to that. Tech and communication services has continued to drive outsized gains in the market, but they've weakened as of late, and partly maybe that's attributed to valuations being a little overextended. The market, though, in spite of the volatility we've seen, continued to have a great year. It was up over 16% as of the end of July. It's pared back some of those gains in the first week of August, but the last 2 days, as we're recording this video, in the first week of August have been quite good. So overall, the market has continued its upward trajectory. There are areas of the market that are now continuing to work better as rate cuts come into focus. And so we continue to see broadening out of the market outside of those two key areas in tech and communication services.
Yeah, and this is really good for investors like us. We're never going to make a bet on one or two sectors. We're always going to be diversified. So having that leadership go from just a couple of sectors, which is really, really hard if you want to run a prudent, balanced portfolio. You can't just put, all your money into two slot machines. By being more diversified as we are, this has actually been really helpful for us. So we've seen a good lift across the board in our portfolio. So pretty strong year so far this year, which has been great. But nothing's cheap, right?
Exactly. Broadly speaking, if we're just looking at the S&P 500 market weighted, and we've had this chart in a couple of our presentations because we are mindful of the price we are paying as it's a forward determinant of returns. Valuations do look quite rich still, trading over one standard deviation above its average, long-run average. That being said, though, if we stripped out market weight and make it on an equally weighted basis, trading around 16 and a half times, which is closer to its long-run average. So there are areas of the market that do remain fairly valued, but we're overall still cautious over some of the valuations that we're seeing across the market.
Yeah, so just to explain that a little bit more, because when we look at this chart that says, are things expensive or not, we have to actually deconstruct a little bit of go and say, like, what are we actually measuring? So we've talked in the past about when we look at the index that everybody watches on the news, our problem with that has been it's weighted based on the size of companies. So the largest 5 or 10 companies they're overweighted in the index. So where they move around, it tends to pull everything with it. So imagine a toddler with a big head trying to walk, right? So if we measure it that way, those larger, more expensive valued companies are pushing up the overall valuation. So when we talk about equally weighting it, so instead of the biggest company having the biggest weight, everything from company 1 to company 500 is weighted the same. That allows us to see that maybe it isn't as expensive. So you're right. There's areas of the market where we're seeing, I think, a better bang for the buck or better price performers. And we try to be a little sensitive to what are we spending, because I like a bargain if I can get one, right? And we see
Exactly.
lots of examples of if people chase what's popular, all they do is overpay. So you got to be very mindful of that. Okay, moving on. I'm
And
sorry I got in
speaking
the weeds
about
there. It gets boring.
potentially, yeah, and speaking about potentially overpaying it and valuations being extended, the Magnificent Seven have continued to contribute outsized returns to the S&P 500. So their share of returns year to date is 51% of the overall return of the S&P
There's
500.
that big toddler's head, right? Everywhere it goes, everything else follows. Yeah.
Exactly. And one of the things that we really honed in on in our last quarterly call was that earnings expectations for these entities were extremely elevated relative to their peer group. And we really wanted to watch closely if these entities were able to achieve those expectations through the first quarter of the year. By and large, they were able to achieve those expectations. I mean, we saw their continued uplift through most of the year into July. But coming into the second quarter of this year, and some earnings have begun to come through, there's been some trepidation with respect to their future expenditure related to AI capital outlays, as well as more difficult year-over-year comparisons. And we see now that the market is pricing in some normalization relative to their peer group, and that's led to a little bit of valuation trepidation for many market participants relative to these entities. So that's one area of the market that we're continuing to watch very closely. Darren, as you mentioned, these entities tend to sway most of the market in one direction, given how much of the index they constitute. And so we're very mindful of their ability to continue to contribute outsized gains to the index, as well as keep up this pace of earnings outperformance.
Yeah, and you can see that even though those companies like Google and actually Google's in that measurement twice, that's how big it is. Meta, Amazon, or Nvidia, like these are the companies everybody loves, but you have to be very careful of what price you're willing to pay. And certainly in the last year, a couple of years have been the most popular, but they also the ones that sell off the fastest. So you should have all learned this in high school, that being popular isn't everything. So moving on.
And moving on, it is specific to that as well. And this is one thing that we're looking at quite closely coming into July, right before the short-term market volatility and downturn that happened towards the end of July. Broadly, equity sentiment in the U.S. became quite frothy. And what that meant essentially is it was trading over 2 standard deviations above its norm. And so the capacity for equity sentiment to continue to improve among market participants seemed quite stretched. So the risk-reward profile at the time seemed a little bit skewed towards middling along and possibly favoring a more tactically defensive approach. And so that's one thing we wanted to quickly draw upon here is that, when we see other periods of time, like in 2018 and 2020, when equity sentiment became overly positive, that was typically a forebearer for then equity sentiment to draw down in accordance with market drawdown as well.
Yeah, and we talked about this in the past, like when we had, that big decline after COVID and everything else. Like we don't do panic here. We don't get scared easily. We also don't get overly excited. And Christian, you and I talked about how the market may have, and maybe not the market, but participants, investors maybe getting a little too excited. So I think our investment strategy is very Canadian. We try to go, kind of middle of the road, very Tim Hortons double. We don't get overly excited. We also don't get fearful. We just kind of move along sideways a little bit. So we were right, actually, that the market maybe got a little too excited. And then we had that little decline on Monday where we gave a lot. We had kind of the biggest drop in a long time, but then followed by a rapid bounce back up again. So let's actually move into some of the macroeconomic background, if we don't mind, about what's actually going on that drives all this stuff. What's the engine, as it were?
Well, and we've talked about kind of the 3 pillars that have supported growth, and certainly consumption, as we can see on the chart on the right, is the outsized contributor to GDP growth in the U.S. And consumption has remained, by and large, to date, fairly strong. And so we see U.S. GDP growth has remained relatively on trend. Growth to date in the U.S. has remained quite strong, even relative to other developed economies in Europe and in Canada, where we see declining GDP growth or stalling of GDP growth. And so broadly, the U.S. economy to date has been quite good, but we need to dissect this a little bit further. And part of that is, well, where has inflation trended? Because typically inflation may actually trend alongside growth. Inflation in the U.S. has begun to come down closer to the 2 to 2.5% target line that we see here on both a core and headline level. And one of the things we highlighted in our last call was that shelter inflation appeared to be disinflationary over the coming months. It's typically a very lagging portion of the CPI basket, usually over a year of lag, given when the data ends up getting released and then incorporated within the CPI numbers. But new tenant rent index, which is a leading indicator for PCI housing inflation, has continued to roll over and continue downwards. And we see inflation within that also following that path. So broadly speaking, core inflation in the U.S. has begun to come down and come down considerably, closer to the 2% target. And so now we need to focus on the other component of the inflation picture, which is more specifically the contribution of labor inflation to services side inflation. And so wage growth is also begun to roll over in the U.S. It still remains above pre-pandemic levels, but wage pressures have broadly eased. If we look at things such as job openings and job quits rate, which is something we're going to dissect a little bit further in the forthcoming slide, those have rolled over and continue to roll over. And so those tend to indicate that wage costs will also continue to decline. If we look at other things such as wage surveys as well as job postings, those also indicate a further decline in wage pressures. So the inflation picture in the U.S. seems to be more skewed towards the downside at this point in time.
Which is by design, right? I mean, they
Yeah.
cranked interest rates from like 1% to 5+%. So they raised interest rates 22 times in 2022. So that really was designed to put the brakes on the economy. We had all the, the reopening trade as the pandemic was over, knock on wood. All that money that people had in their bank accounts and their savings accounts, which we're going to show in a minute, we had unprecedented amounts of savings. So people were spending it. They were traveling. We talk about revenge travel, revenge purchases. So that was getting to be too hot. They cranked interest rates, kind of derailed the stock and bond markets for that year. And the goal of that was to do exactly this, was to slow it down. And so the good news is, depending on where you are in this thing, because if you lost your job or weren't getting an increase, maybe it's not good news. But in aggregate, the economy is beginning to slow, and these are the indicators. So as investors, it's important that we know where we are. And I think that these are some of the flashing yellow lights that we're seeing as we drive down the road. And that you have a chart coming up that's going to talk a bit more about what demand is doing, because wages are one thing, but demand is a connected item here.
Yeah, so we've touched on this chart, openings and quits rate, which is a contributor of basically what is labor demand in the States. So job openings, so those are the amount of jobs that individuals are able to get based on corporate openings for jobs. Those have come down but remain above pre-pandemic levels. But certainly, as we can see, they've come down considerably since their peak in March of 2022. Job quits, JOLTS quits rate as well, it is now about its pre-pandemic levels. So that's the propensity for someone to willingly quit their job and then find other gainful employment. So if an individual thinks they can quit their current employment and find a better job, they're going to do that. But to the extent that those jobs no longer exist, then they're going to be staying in their current situation. And so that's another forebearer of the possibility for a slowing in wage growth as well as in labor demand. And so layoffs have remained fairly muted to date. But as we're going to get to the next slide, there's been some recent data that has given us additional caution with respect to the U.S. labor picture. So people that have lost their jobs, so what we would entitle them as permanent job losers, so they've lost their job and they're unable to find new employment, that's begun to increase slightly. In addition to that, as we see on the chart on the right, if we just look to history, when job openings decline to the level they have, typically the next step up is that you would have a rise in unemployment. Recently, what we've seen is that initial claims data in the U.S. has come in higher than expected. Non-farm payrolls data as of the end of July came in below expectations. The unemployment rate rose 20 basis points more than expectation. It has now risen quite considerably over the last 12 months on a rolling average basis. And so bad news is actually starting to become bad news within the market, and that's contributed to some of the volatility that we're looking at. But as you mentioned, Darren, ultimately the central banks wanted this to happen. They want to carefully thread the needle between having an excess rise in unemployment, but also allowing the economy to slow down a little bit so that inflation could come back towards trend.
Yeah, this is what they call a soft landing. If you remember those videos of, with SpaceX, Elon Musk's other company, where he's trying to land the rocket ship on the floating island thing, like, it's hard to do, really hard to do. But also the other thing I think we have to remember is that a lot of these data points are coming from historically really, really low levels, like really, really low unemployment. So yes, we're seeing increases in some of these things, but they're coming off of historically low levels of unemployment, historically low levels of people being permanently unemployed. So it's not a panic attack. It's just a change from what people were used to for the last couple of years.
Exactly.
But the next one here, this is a big one here about, sorry to interrupt you, about savings rates. This is something I've been watching for a while.
Yeah, and so when we speak about the levers of the consumption basket, we've also looked at leverage in the past, so the propensity for consumers to take on debt and the type of debt that they're obtaining and delinquency on that debt. That's remained fairly stable quarter over quarter, so it wasn't worth including in this chart back. But we've touched on labor and wage growth, which seems to be declining. And the other aspect of that picture is savings. So for a large portion of time, and this is something we continue to harp on, consumers were buoyed by the excess savings built up through the pandemic. And a lot of that was through fiscal subsidies. By and large, excess savings now appear to have been almost fully drawn down. And so consumers are no longer supported by all the subsidies that they built up over the last 2 years. We haven't quite seen that come through in the savings rate yet within the U.S. So what we would eventually expect to see is that as consumers become more cautious and they don't have these excess savings to spend, they would actually begin to then save more of their income and then spend it less on goods and services, et cetera. So we haven't seen the actual savings rate come up considerably, but excess savings are almost fully drawn down, if not all drawn down. And really where we're seeing stresses on the consumer at this point is on lower income households. So that 0 to 20% bucket on the bottom right chart here, we see that in inflation-adjusted growth in deposits, they've had an outright decline of 21%, whereas other income categories have been able to increase their overall deposit base. So what this means is that those households are spending more than they're bringing in, either through their wages or as through their propensity to obtain loans or lending. And so to this extent, lower income households are beginning to experience some stresses. We've also seen this through recent earnings releases for a lot of consumer discretionary entities. In particular, they've made notice that lower income households have been consuming less. They've also been trading down. So the theme across restaurants and the retail industry is that consumers are no longer spending on those really high ticket items, and they're beginning to be more budget focused.
Yeah, and one of the things that I find really concerning, I'm just going to editorialize here for a minute on a political view. I think a lot of the reasons that lower quintile of employee of the employment and the income population is really having trouble is because a lot of policies that have been created to help them are actually doing the exact opposite. So things like minimum wage legislation, rent controls, these are designed well-intentioned to help that population, except they screw up the functioning of a market and wind up, I would say, hurting them to a larger extent, right? So, if you jack up minimum wage so high, yeah, you're maybe offering a living wage to people in one case, but you've also reduced the number of jobs that are available and people being able to enter the workforce at that level. So, a friend of mine who grew up in communist Russia, she had a good point. She said, yeah, bread was cheap. There just wasn't any. So, government can try and control the price of something, but supply will adjust accordingly. So, as I say, some of the policies that I think people have been enacted to help are actually causing more damage, and maybe we need a bit of a rethink of that. The other chart that's really interesting in this mix is the one on the left. About if you look at historical savings rates, this is just behavior and financial literacy, and I think the way our people just deal with money since then. I think we've seen an explosion in credit since the 60s and 70s and 80s. Like there really weren't credit cards in the 60s, whereas now every kid's got one or three. So the ability for people to become bigger consumers, use debt, and just the idea of what an average lifestyle looks like has really grown, which is why we've seen savings rates. Like savings kind of cute now, but it's extremely vital. And one of the examples I often show of just how much things have changed is media and what the average family looks like on television. So I want people to be mindful of this. If you go back and think about the TV shows that I grew up with in the 70s, and because I'm only 26, so I'm hypothetically here. But if you go back and look at TV shows from like the 70s, whether or the 80s, right? So whether it was Happy Days or One Day at a Time or Blue Sea or whatever these things were, they were always fairly modestly shown. They were showing the average North American family having a modest lifestyle, which was in keeping with what the populace was like. Today, you look at the average TV show and the way the average family is represented, and like, are these people all multimillionaires? Because there's no way the average person could hope to have a lifestyle that they're seeing on television. So I think media has expanded what people think is normal, and buying luxury brands and luxury goods is just the way we are. So I think that's also strained the average person's wallet, which is also why that excess savings fell off so fast. The money people accumulated. So this is maybe just me pontificating a bit. I think people maybe need to go back and learn the values of thrift. But I realize I'm fighting a tide of media and information that, I'm not going to wrestle with Madonna and Lady Gaga on what popular culture is like. But anyway, moving on, let's talk a bit about we talked about savings. Now, connected to that are interest rates, right? This
Yeah.
seems to be everybody's pastime. I think is where we think interest rates are headed.
Well, exactly. And we went into the year saying that the market was over exuberant with their expectations for interest rate cuts. And then we reached a point about middle of the year, a couple months ago, where the market was basically in line with Fed expectations for interest rate projections for the remainder of the year.
And by
And
the way,
then,
you and we have talked, and people can go back and watch your videos. We've been saying for a while we thought rates would stay higher for longer. So we were out of step with pop. Remember, I talked about being popular. Our perspective was maybe unpopular, not a step, but hey, turns out we were right.
and so, we've just spoken about really, employment maybe showing some cracks in the U.S. employment picture and the aforementioned poor jobs data. In accordance with that, markets are now pricing in an easing of about 100 basis points until the end of the year, and attributing a 60 basis point probability to a 50 basis point cut in December. So in accordance with that, we've now seen some dysfunction with respect to Fed expectation and what the market's pricing in. Market's pricing in a pretty significant increase in rate cuts, and the actual increment of rate cuts. So the Federal Reserve has typically done 25 basis points in terms of rate hikes, and they've signaled broadly that they would also have 25 basis points in rate cuts. And so we're now seeing a little bit more dysfunction in the fixed income market, with market expectations becoming more aggressive than the Fed. And so we would just caution that unless the employment picture severely deteriorates from this point forward, and that's something we're very carefully looking at, it's unlikely that the Federal Reserve will significantly change its cadence. Recently, they have reintroduced their dual language mandate. So if you recall, the Federal Reserve is not only concerned about having inflation at a long-run rate of 2%, they also want to maintain maximum employment. So as they continue to look to thread that theoretical needle that Darren mentioned and achieve that soft landing, we still don't think that they're going to be able or in a position to cut as aggressively as the market's pricing unless there is more and significant deterioration in the labor market, in which case that's going to just contribute much more volatility to the equity markets. And we've begun to see that in part over the last couple of weeks. So
I think we're going to stick with our rates. They're going to come down, but they're going to stay higher for longer than other people expect. That's our
yeah,
belief, and that's how we're managing things. But yeah, this is extremely important. I think Monday we had a really bad day in markets, which fortunately we were closed because it was a civic holiday in Canada, so nobody could do anything. Not that we would panic anyway, because that's not what we do. But the last 2 days, markets have been positive. So volatility, that thing nobody likes, back. The problem with volatility is that it's volatile.
yes, exactly. And we spoke about the possibility of reintroduction of some volatility, and we highlighted some events such as interest rate volatility. We also highlighted going into the year continued geopolitical tension that would contribute to volatility. And so all that's kind of coalesced as of late. There's also been a fairly intricate market phenomenon whereby the yen carry trade, which has kind of taken over headline news, whereby you could borrow for a really long time in Japan at essentially 0% or close to 0% interest rates, and there was really no expectation for that borrowing rate to change because the Bank of Japan for a long time was in what was titled yield curve control. Recently, they've exited this, and they just recently raised by 25 basis points, which was above market expectation. So all those people that were borrowing in Japan, taking that money and investing in other economies, either getting a higher interest rate elsewhere or investing it in U.S. equities, all of a sudden the yen began to appreciate, and so the amount that they have to repay that they've just borrowed has increased. And so some of the leverage of the economy started to unwind. As this has happened, we continue to see geopolitical tension in the Middle East continue to rise, and we talk about some of the poor employment data which took the market by surprise in the latest weeks. All this came together, and we had the largest intraday change, as you mentioned, Darren, in the volatility index that happened on Monday. It's come down quite a bit from that 40-point high that we see on this chart. But nevertheless, we do expect volatility to remain more elevated than it has over the last few months. And certainly that's not something that we should think is unexpected, given that we're coming off very low levels of sustained volatility.
Yeah, so bumpy road ahead, everybody. So just do your seatbelt up. Just, keep your head and arms inside the ride at all times. But yeah, we do expect to see more of these, maybe not that severe, but certainly as a lot of these cross currents start to come, whether it's the unwinding of the carry trade or what US inflation is doing, a lot of these things are going to start bumping into each other. So we do expect volatility. And I think as investors, by the now, you should have learned that that's just part of the deal. So we're not going to panic. We're going to try and see through it. So just this is the way it's going to be.
Yeah,
So
and to
one,
put it to more focus as well, I was recently reading an article that says the odds of a 5% correction in any given calendar year is 64%. So
right.
we shouldn't take this volatility as something that is entirely abnormal to the overall market cycle.
Exactly right. Look, I wish my golf score would be within 5% apart because it isn't. You've seen me golf. It's yours is, mine isn't. But yeah, I think that's just the nature of the deal. So if anybody's worried about this, then maybe we should just put all of your money into a GIC and you can walk through your retirement as opposed to run. But so this is not really risk; it's just fluctuation. But I think we're going to get more of it going forward. So just we're going to have to buckle up and get used to that. Let's We've been talking mostly with US data, Christian, because that's where most of our portfolios are, most of our investments are. Why don't we look at Canada and see what does that look like? Is it better or worse?
Yeah, so the picture in Canada at least appears a little more clear with expectations for the slowing of the Canadian economy. Retail
Clear does not equal good, though, does it?
No, it doesn't. Retail sales volumes, which by proxy show the health of the Canadian consumer and their propensity to spend, those have been continued on a decline. Business outlook survey indicators, so their expectations for future sales, have also been on a decline, and those are tightly correlated to real GDP growth. And so the expectations here is that the Canadian economy really is going to continue to muddle along and slow down. And that's really also been reflected in a significant increase in the Canadian unemployment rate percentage, which is now over 6%. That is not something that's looked to stabilize anytime soon, just given that survey hiring intentions, which is the chart on the far right, is also still in a market decline. And that's typically led private employment data. So the employment picture in Canada still remains very weak. Our consumption indicators are quite weak. In turn, if we take that all together, it means our expectations is that the Canadian economy will continue to slow. And on the positive side, that feeds into continued downtrend in inflation back towards our 2% target. So if we really don't have great growth, which is not good for the overall health of the economy, on the positive side of that is that inflation will continue to come back down. Goods inflation is basically non-existent at this point. Services inflation has come down. It remains somewhat elevated, partly due to wages, but partly also due to shelter inflation. And shelter inflation, is worth mentioning, is a direct feed-through of higher borrowing costs and higher interest costs. So the extent that the Bank of Canada will cut rates in the coming quarters should help alleviate some of the shelter inflation that we're seeing.
Yeah, so go to the next chart for a second, because I got a comment on this in a moment about where this goes to interest rates, because they've certainly, our economy has been slowing down dramatically. I think there's a risk that it falls off its bike, because if it goes too slow, that could be what happens. We've seen interest rates begin coming back down, which is good, but our dollar is also getting punished as a result of that, because as soon as we get to have a lower interest rate than the United States, money leaves our country, and there's less reasons to buy stuff up here. So as you can, that chart on the right shows I want Canadians to think about this as the inverse. So that's the Canadian dollar dropping and the US dollar getting more expensive for us. And I think most Canadians would appreciate that makes everything we buy more expensive, which in itself could be inflationary. I want to make a note, and again, I'm going to editorialize for a second. Our finance minister sent out a social media tweet, community post, I don't know the words because I'm over 26, but she sent out a message saying that the fact that interest rates have been coming down and inflation is coming down is a sign that the government's economic plan is working. Christian, I think humbly you and I maybe want to do a webinar for our prestigious finance minister, or maybe that's actually the opposite is the way it works. When interest rates are going down and inflation is going down, it means our economy is slowing. So unless that was their economic plan, I'm not sure that's a sign of it being highly successful. So I'll let Canadians figure out what they do with that. There's no election coming in Canada for a while, so we can't do anything about this. But I think except just bear that, maybe interest rates will come down. That's good for borrowers, but not good for shoppers or tourists that are trying to go somewhere else. I think we're going to continue to see our dollar get weaker. I think you would agree with that, maybe.
Exactly that. Yeah. So the projections of the Bank of Canada will probably cut at least twice over the remaining three meetings. With the Federal Reserve beginning to cut rates in September, it's possible that our cross rate here, USD CAD, remains somewhat stable. But as you mentioned, Darren, Canadian economy just continue to weaken at a quicker pace than that of the US at this point in time. And so we do remain quite cautious on any near-term movements of the Canadian dollar to the upside.
Yeah, and if people want to see kind of what this movie could look like, when an economy begins to weaken worse than its neighbor, and what that could mean, I think if you just want to Google the drachma, the lira, or the dinar, you'll get a sense of what could be in store if we don't smarten up on how we manage the economy here. So, okay, speaking of managing things, let's go to the U.S. election, because that's been a bit wild the last few weeks. I was just joking I just did a walking with Darren video because, Charlie's retired. And I talked about this, and I think there was while there, a lot of us were thinking, man, whoever makes it to November is probably going to be the president, because we had President Biden clearly looking like maybe he's not as vital for the next 4 years as we all would hope him to be. So he's decided to exit the running. We had the really unfortunate assassination attempt on President Trump, and unfortunately someone lost their life and two people were badly injured in that. That was a shocking failure of the security people around him. So fortunately he's okay. None of us here, by the way, got our commemorative ear bandages. That was a bit ridiculous. I watched that at the national convention. But we certainly have quite the race. It looks like Vice President Harris is going to be the Democratic candidate. They have to have their convention to validate that, but that looks what we're seeing. So a very interesting race. I would say competency is sidelined for both candidates. So that's just my view of it. I wish we'd had maybe a higher level of skill on display, but we have what we have. But I think what we've learned from this chart is it doesn't really matter, does it?
No, it doesn't. So we have periods of time where obviously the economy weakens, and that's happened regardless of the presidency. So you may have a bear market for a short period of time. But over the long run, regardless of the political party in power, the markets continue this uptrend. And this kind of goes back to what we speak about, Darren, in taking a longer-term view of things and not being susceptible to short-term bouts of volatility.
Yeah, and I think obviously for us, whoever the president is, there's usually, that just maybe tells us which way the wind might blow in terms of certain sectors may be more in favor or less in favor. So we would tilt our portfolios a little bit, but we certainly wouldn't head to the exits just because someone got in and we didn't like whoever it is. And I would argue that there's an adage that we like to follow when we look at companies. One of the things that we like are finding companies that are somewhat idiot proof, because they'll withstand if some idiot winds up running it, right? So we like businesses that are so powerful and so strong that they'll even survive bad management. And I would argue that the White House, I think, operates from a similar perspective. So, okay, let's move a little bit further into what tends to happen, by the way, in terms of markets between the primaries and the actual elections.
Yeah, just for that point, if we look at historical data, in election years, we do see enhanced volatility in the markets, but typically after primaries, so after the summer months, the market is actually rallied into the election day and then forthcoming after the election of new president. So all this, needless to say, is, we don't actually want to be concerned about an outcome that we can't control and is frankly unpredictable at this point in time. Rather, we continue to look at key aspects such as what is the actual health of the economy, what are indicators of the health of the economy that we can discern, and as you mentioned, Darren, just continuing to find fundamentally quality businesses from a bottom-up stock selection approach. And I think the best way to characterize this approach is really through this picture here.
Yeah, we had fun watching this. This has become a big meme from the Olympics, where I think most are the market participants, the talking heads on TV. I think they're all like that Serbian pistol shooter, where they get all their gadgets and their gizmos, and they try to take a really. I think we're a little more like Yusuf Dikic, I think I pronounced that right, who won the silver medal in air pistol for Turkey. I think they just got their version of John Wick and put him out there. No ear protection, no a fancy ice hand in his pocket, just And you made a good point, Christian. You think this guy's trying to fly under the radar, so he only wanted the silver medal, not the gold, because then he's gonna, like, people will know him. There's a little bit of like
Exactly that.
keep it on the down low. This guy. So I think as investors, I think we lean more towards our John Wick from Turkey. Just be cool. We've seen a lot of this stuff before. Some of it's new, but a lot of it isn't. And we'll just try to remain calm, cool, and collected, and still hit the target. So, Christian, great job. Thank you. We're right on 35 minutes. Thanks for putting those charts and slides together. Thank you all for watching and sticking through to the end with us. Have a wonderful summer. If you have any questions, comments, or anything you'd like us to zero in a bit more on in these talks, please drop us a note and let us know. So with that, Christian, thank you very much. Enjoy the rest of your summer.
Thanks, everyone.
Bye-bye.